Hello guys, good morning. In this video I will try to show you how to short stock. Okay, now to short a stock, it's an advanced technique. Is in general it is to set to sell shares that you don't own, then you recover them back, okay, by buying them. So to sell shares that you don't own, it means when you want to go down, let's say I give you an example. For example, the stock price is $20, okay, and according to your research, you find this company has problems and maybe the price will go down. So what you do, you go to your broker through the platform, and instead of going to the, we have, when you want to buy or sell, we have what we call the bid, and we have the ask. Okay, so the bid here, you find sell, and in the ask, as you might know, it says buy. Now for you should go to the bid and you hit sell. Okay, you hit sell, not buy, because you are selling shares that you don't own. You sell. Now your broker will give you these shares, okay, like 100 shares, 200, 1000, whatever you need. And then since you sell them, okay, you sell, for example, $20 a share. Suppose your trade is going good, and after one day the stock is, let's say it is $18. Okay, now when it is $18, you buy them back and you give the shares to the broker. Okay, so it's the opposite. You do the opposite as when you go long. Okay, so this is just an example. Is you hit sell and you buy or you sell how many shares you need, 100 shares, 200 or 500 or what you like, and then after one day or two, or depends on your style of trading, the price will be 18. So you sell at 20 and you buy at 18. Okay, and then you give it back to all this is automatic. Okay, so you just hit sell, you put the shares and you buy, and then after one day or two or three, and then you buy again and you give the shares back. It means what you are doing here when you sell shares, it means you borrow shares and you short them. You borrow shares from your broker and you short them, so expecting that the price will go down. Okay, so this is how to short a stock. Now let's go. This is the heart of the thing. But before, let's say before you short, okay, now what's the requirement? Okay, so what are the requirements in order to short? First, you should have experience, because the broker will not let you short a stock if you have no experience in trading. Okay, sometimes when you want to for the first time you want to short a stock, and you find a notice that you cannot sell this stock short. They say because you don't have experience, and you should apply for this. You should ask them that I want to sell. Okay, because I will explain later why it's you need experience. And this is one. It means you need experience. Now, second, what do you need? You need what you call a margin account. A margin account, it means is an account where you have your money plus broker money that they give you. Okay, for example, this is what you call margin account. It means, suppose that you have $5,000 and you have, for example, cash account. Cash account, it means you cannot do shorting stocks. You cannot do cash account. It means the broker doesn't give you his money, so you don't borrow any money from the broker. So in order to do what we call shorting a stock, you should have what we call a margin account. It means your 5,000 cash account, and then you apply for a margin account. Now, when you apply for a margin account, this is most of the time it's automatic. Okay, it means just you ask more money from the broker. So you have $5,000 plus $5,000 of the broker, so you will have $10,000. Some people, a lot of people, they do, most of the professional, they have margin account. It means first you will have more money to buy stocks or to sell shorts, and second thing with this margin account is you have the ability to short a stock. Okay, now why you apply for why they don't let you short a stock very easily? Why when you buy they don't care? Okay, when you buy a stock, okay, buy a stock, the broker doesn't ask you. It's easy. They don't ask you anything. You buy wherever you want, and you sell wherever you want. It's your account. You do. There are like a lot of freedom, okay, to spend your money as you like. It's like when you go to a casino, or when you go to a restaurant, or they let you do wherever you want. You eat whatever you want. You do wherever you want. But for shorting, okay, short a stock, you should have experience, and you should have a margin account. Now, another thing, why shorting a stock, they ask you to have experience and to have a margin account, and you apply for it. Why? Okay, when you say why, because it is dangerous. It is more risky for beginners than buying a stock. Now, I will give you an example why it is risky. For example, let's say this is the opposite. This is when you buy. So when you buy a stock, let's say you buy $5,000 stock. Okay, this $5,000, it means, let's say I just give you an example. Let's say $5,000, and the stock, let's say, is $1. Okay, let's say the stock share is $1. So how many do you need? You buy 5,000 shares. Just an example. Okay. Now, when you buy a stock, it could go up and you make a profit, or you lose. Now, suppose you lose all your money. Suppose that this stock goes from $1, it goes to 0.001. It means the company has bad news and no earnings, and it may be delisted, this company. Okay, or it is just a pink sheet a stock. It means it's just nothing. Okay, so if you lose, how much you lose? You can lose all your money. Okay, you can lose all your money here. This is the last thing that you can have, is you lose all your money. Now, let's give an example of when you want to short a stock. Okay, let's say you want to short a stock, and the stock is $1. Okay, you want to short it. For example, you say this stock has bad news, the company has bad news, and it's $1, and I am sure that this stock will go down. And if it's going down to 0.00 001, I will make too much money. I will make, for example, I buy $5,000. This is just an example. $5,000, 500 shares, and if it goes from $1, it goes. I can make 5,000 or more. So it's a big money, and it's a big money. So you will have $10,000. Now this is just an example to show you the thing. Okay, 5,000 is $10,000. Now, what will happen? The opposite. If your stock goes the opposite thing, for example, from $1, it goes to unlimited. Unlimited, it means it can go from $1 to 100,000 or more. Okay, there are some stocks like Warren Buffett, if you can see Warren Buffett, Hathaway, Berkshire. Okay, is right now is I think $65,000 a share. Okay, so the stock can go up to unlimited. There is no limit to the stock. So do you know how much money you can lose if you hold on your short? Okay, normally when you lose all your money, before you lose all your money, the broker will ask you to stop, because you lost all your money, and the house will not lend you money. Okay, but suppose this is just the normal thing. Suppose that you have millions of dollars, and you want to play this short, and it goes up, and you want to stay in this position. Okay, that's why we say shorting a stock is difficult, and it's risky for the beginner. Okay, if someone is not a beginner, he a professional, he knows what to do. So for example, let's say the stock is $1. For example, he says if it goes to $1.50, I will buy back the shares and give to the broker. At least you will have a loss like 20% of your money. Okay, 20% of your money. So this is just an example of how to short, and on the opposite side, how to buy a stock, because this is the thing about the buying a stock and shorting a stock. So shorting stock has an unlimited potential of losing money, and in the other side, it has a potential to have a lot of money. It's this but they are not the same. When you buy a stock, you can lose all your money. That's it. Because when the company it goes to 0.001 or like 1 cent, and it was $1, you lose all your money. But still, only the money that you have you lose. But shorting the stock, you can lose this trade, and if you have in your account, you have, for example, 10,000, 20,000, you can lose all the other money too, because you are in a position where you are losing money and you are staying in this position for a long time. So this is the difference in terms of this trades. Okay, let's go to the charts. Okay, now see this very big red candlestick. This it could be a shorting, because selling, some people who sell their shares and shorting stock, they go together because you don't know which is which. So this stock, it opens at 6.97, and by the end of the day it becomes 5.20. Okay, and some people, they recover here. So as I say, they buy here. They sell their short here. Okay, they sell short here, and they buy at the end of the day here. They buy here. You see this spike, this thing here, the tail at the back. They buy here, and some in the morning they buy. Most of these things are day traders. Okay, you find in one day, it's day traders. Some they short for many days. This is for like swing trader. It means each day they short for a little bit, and they wait. The next morning they will short again. This, it could be a lot of traders together. Okay, because this kind of shorting the stock, most of the time they are like what you call professional traders. So sometimes they work together and they go to a stock and they short it. So this short has nothing to do with the company. This is the problem. Some people, they don't understand this notion that trading most of the time has no relation or limited relation to the company itself. Okay, you find, for example, a company that it is a good company, but some people, or some big traders, or especially hedge funds who have billions of dollars, okay, they go to a stock that it has done very well, and they short it. Okay, now shorting could be done in the day, as we have seen here. Could be in the day, or sometimes it could be done in the night. So let me give you an example. uh, Let me give you an example of something that happens. I don't know where I see. Let's see. Let's go to the chart like this and try to find you. Yeah. See this. See this chart. Okay. See here, for example. This stock is called ENZN. It's a pharmacy stock in biotechnology. Now, it was trading at 3.22 on the 4th of June 2013, on Tuesday. It was 3.18. Now here, what happened here? Here is night. There are bad news, or just some big traders or hedge fund, they want to take the money of the stock itself, so they sell short here from at night. It means when the market closed, and the price was 3.18. Now the next morning, the stock is 170. Okay, so 170, 318, it's nearly it's like 45% is gone from the stock. Okay, that's why I always ask beginners not to go to these penny stocks under $5, because they are too risky. There are a lot of people, a lot of traders, they short these stocks. This is not the first time this stock was short. This is in June. There is another shorting in which one? Which in December. So they shorted in December. They shorted in June, and some they shorted for a long run. They leave the position like this, going down, 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 because they know, because these people are the same people who are doing this stuff. It means taking the stock down, 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 down. But from December, this stock has lost a lot. In December, in 30th of November 2012, the stock was 731. Now it's 1.92. It means it lost about 75%. Okay, so hope you understand this lesson of how to short a stock. And if you have any questions, just ask. Thank you very much.